Hey guys, do subscribe to the channel if you find our content really helpful so that we can keep putting out resources for the less privileged. So in this video, we're going to look at how expenses influence or affect the financial statements and how it moves through it moves between the three different financial statements. So going from the previous example, let's presume you've got a pizza store that does $10 for a pizza. Now let's say for some purpose you had to go out and research on the different pizza places around your locality. You had to put out a few flyers to improve your sales and your marketing, or if you had to pay out your staff. Let's presume that the operating expenses costed you a total of $10. Now when you go out and you put out flyers, or if you had to pay out your staff, you essentially take money from your wallet and you pay them out. So what that means is your cash component on your balance sheet, it drops by $10. Now, if you have an employee that you're going to pay out in the end of the month, that goes in accounts payable. If you remember our balance sheet video, accounts payable is just deferred payments that you have to make. So it's money that's going to go out of your pocket in the month or in the quarter. The next thing that happens is your cash disbursements get another additional 10. Because again, like I said, cash disbursements is money that's going out of your wallet. So if you had to pay $10 for marketing or for sales, you have to put that extra $10 into cash disbursements. And what this means is your retained earnings, basically the money you had in your wallet, drops by $10 because you've paid that out. And that would bleed on to your shareholder equity. So you have a minus 10 in there as well. So as a quick recap, let's presume you've got expenses. And your expense is, let's say, plus 10. So you have to pay out 10 to put out flyers. The first thing that happens is it goes out in, you have an additional 10 going into accounts payable. So you need to pay your staff or the guy who's going to go out and put the flyers. And let's say that you've already paid the guy or the staff to put out the flyers. Your $10 from your accounts payable cycles and goes into your $10 for cash disbursements. Keep in mind your cash flow is the movement of cash. So once the cash has been paid, it goes from your accounts payable all the way to your cash disbursements. That's money that's out of your wallet. Now, what this means is you have a deficit in cash by $10. So if you open your wallet, you had $50, you've paid out 10, you've got a deficit of minus $10, or you've got $40 left. And that means your retained earnings at the end of the day will drop by $10 as well. And your shareholder equity would drop by $10